Hello and welcome to India Invest, a channel where you learn the basics of fundamental investing, value investing, as well as find great opportunities to invest in the Indian stock market. Today's video is about one of the most important aspects of fundamental investing. So if you put up a list of things that great investors look at before investing in a company, this is probably the number one thing that they look at. So when Warren Buffett or Peter Lynch say start reading an annual report of a company that they're trying to research, this is the thing that they are trying to find. And that thing is an economic moat. So in this video, we are going to understand what are economic moats, what are the different kinds of economic moats, and why companies even need them. Can we have a company that does not have an economic moat, which will be a great investment? So we'll answer all of these questions in this video. So sit back and learn. So to explain you what an economic moat is, I'll try to show you an example of a business. Now imagine you live in a town that does not have a pizza shop. I'm very worried about you because you're living in a town that does not have a pizza shop, but let's imagine you do. And you decide, because you love pizza, you decide to start a pizza business in your town because it does not have a pizza shop. You have tried many other pizzas in different cities of the world, and so you decide and create your own menu with many great recipes of pizzas, different kinds, and you put it out in your tiny town. And everyone in your town suddenly hears about this business and they all want to try. And very quickly, your business is very successful. Now, all the other restaurants in your town are very worried because you now have something that they don't, which is a lot of customers. So they are cribbing and crying and discussing, and a few of them decide, okay, if this guy can make pizza, why can't we? And very soon, tens of pizza shops open in your town. Now, this is the perfect example of how businesses operate and why businesses need an economic moat. Because now, initially, you had only one pizza shop, there was no competition. But now you have many competitors, and the business that has an economic moat will be the business that will survive, because not all of these pizza shops are going to be successful, only a couple or maybe three would be. So capital always flows in the direction of highest returns. So when a company gets successful, competitors want a piece of that cake as well. Competition increases, and the company now has to continue its business in increased competition. This is literally how free markets work. There's a lot of competition, and the best competitor wins. A mediocre company will fail in the light of this new competition. And so, to remain successful, a company must be able to prevent itself. For that, it needs a moat. Now, what exactly a moat is, if you don't know what a moat is? So, in the olden days, when forts and castles used to exist and people used to live in them, there was this moat, which is like a ditch that was made around the fort or around the castle. And this ditch was then filled with water. Sometimes it was filled with crocodiles as well, to give an additional layer of protection for the castle. So if you see that drawbridge, so if they just pull up the drawbridge and someone wanted to enter the castle, they would not be able to unless they find a way to cross that moat. So that moat was a way to prevent themselves from the enemy, which is exactly what businesses need to do. Is they need to have a moat, a large ditch with water and crocodiles in it, that can prevent it from their competitors, so that the money from these competitors does not eye the profits of our successful business. So there are thousands of companies out there. how do you know if a company that you're analyzing has an economic moat? Well, you can ask a very simple question, and that is, why can't competitors steal the market of this company? Why are customers not moving to another company? What do customers like best about this company? So these are the kinds of questions that you can ask when you're sort of analyzing or reading about a business. Is why is this business still in business? I mean, what is preventing the major giants of competitors from coming and stealing the market of this company? What is this company doing that is so special that their customers are not leaving them, and why are its competitors not able to take the market from them? So I'll give you a few easy ways you can understand if a company has an economic moat. So the first is, look at financial statements, and the first thing you should look at is cash flows. As many people say all the time, cash is king, and it really is. So look at the free cash flow, which is basically, in the cash statement you will have a cash from operations uh, row, and below that you will have a cash used for investing or capital expenditure. So if you take the cash from operations, which is what the company earns by selling its services or products, minus the capital expenditure, that is the money that the company puts back into the company to expand it, or to maintain it, or to put up a new plant or whatever. So that, if you remove that expenditure from the cash that the company generates from its business, you get free cash flow. So this is the cash that is left with the company after reinvesting. So what you have to do is just divide this free cash flow by the revenue. So say the free cash flow comes to around $1 million and the revenue was $40 million. So the free cash flow by revenue is 1 by 40. So if this number is more than 5% consistently, you have a great company at hand. So you need to realize that the revenue that comes into company will pass on to many different components. It will go into depreciation, it will go into uh, cost of goods, it will go into administrative costs, it will go into taxes, and then there's capital expenditure, of course. So the cash flow is a very small part of revenue, but if a company is able to generate this 5% consistently, you have a great company at hand with possibly a moat. If this is more than 10%, you definitely have one. So how do you find consistency? Just do that for the last 10 years and you will know if a company has a moat. Another easy way you can check if a company has moat is check its net profit margins. So you can use the income statement for this. So check for high net profit margins. 15% or more is great. Margins also depend on industries and sector. So some sectors are bound to post better margins. So for example, an IT sector company will probably easily cross the 15% net margin, but that may not be true for an airline company or a steel company. So compare company with its industry peers for a better picture. So if every other company in the sector has a margin of 8%, but this amazing company has a margin of 19%, check what it is doing differently and why are its competitors not able to post that net margin. Consistency is key. Again, you shouldn't just uh, check the value only for this year or last year. You can go back 5 years, 10 years. It's not very difficult to do that. So consistency is key. So if a company can consistently hover close to a similar net margin, it is doing something right. So it shouldn't happen that one year it's 12% and then another year it goes down to 2%. So that is probably a cyclical business and may not actually have a moat. So consistency is key. So return on equity is net profit divided by shareholders' equity in the company. It measures the money company makes per dollar invested in it by its shareholders. So ROE is basically net margin divided by equity, and equity, as we all know, is asset minus liability. So check for ROEs above 15%, and you probably have a good company at hand. Compare company with its industry peers again, and consistency is key. Look at 5 years, 7 years, 10 years, and not just last year. And if this number is consistently above 15%, then you probably have a good one at hand. Another important ratio that you can use is return on assets. So it's pretty similar, but instead of dividing it by the equity as we do in ROE, in ROA, it's net profit divided by the assets of a company. So it measures the money that a company makes per dollar in assets. Check for ROAs above 7%. And again, look at a large, and for a better picture, look at 5 years or 10 years and not just 1 year. So to sum up, if you want to find if a company has a moat, you can just go into its financial statement and use the income statement and its cash flow statement and its balance sheet to find, to sort of have a guess of whether a company really has a moat. Because if a company is a good company with a great moat, it means that it is able to fend off competition. If it's able to fend off competition, it means that it is able to consistently make money, which is the whole point of a business. And these 4 points are essentially a way to gauge if a company is able to consistently make that money. So a strong cash flow, a return on equity above 15%, a return on asset above 7%, and a net profit margin above 15% is probably a good sign that your company has a moat. If all 4 of these are present, then this company is definitely worth reading and analyzing and digging deeper into. So now that we know how a company with an economic moat looks like, it's also important to understand what kind of economic moat a company has, because financial statements are only a result of the business. It's not essentially the business. So we actually have to understand the business as well to understand the financial statements, which are like sort of a product of the business. So basically what we want to answer is, why are customers not buying from competitors, or why can't competitors steal the customers? So when trying to find an economic moat of a company, try to think as a customer. If you were a customer of this company that you're analyzing, why would I prefer this one over any other? I mean, there are a lot of options out there. What is so special about this one? And when you find the answer, you have found the company's moat. So essentially there are 5 major kinds of moats. We will go into detail for each of these, but these are the 5 kinds. So one is product differentiation, second is product brand, third is low cost, fourth is locking in customers, and fifth is locking out competitors. So let's go into each one of them. So the first one is real product differentiation. So this is probably the most intuitive moat. So if I ask you what business you'd like to start, you'd probably say, I want to make something that is just out of this world, or no one else is making that sort of product, or something that's just completely different, or completely new features, new improved technology, new material, etc. So this is probably something that we all think about when we uh, think about making, building a company. But honestly, this is a flimsy moat because better products means, I mean, the biggest drawback is you have to charge a premium to the market. This essentially reduces the amount of people that you can address. So if you have created this great cloth material that's just the most amazing material, the most comfortable one, and it just wicks moisture and all of those amazing features, and you have put in a lot of money into its research and development, and you have to sell this product now, so you will probably charge much more than someone making a cotton shirt. So essentially, you will not be able to sell it to everyone now. You will only be able to sell it to a small number of rich people. So most products can be copied and competitors will eventually catch up. So this is another important thing. There are a lot of products that come out in the market every year which are touted to be very different or very unique or just amazing, a lot of improvement. But competitors always find a way to overtake you. They eventually catch up. They will create something that's better than you. So this competition will keep on happening, which also means that constant innovation takes a lot of investment, and profits from superior products are generally short-lived. So this will take a lot of money into R&D, into product development, into marketing, into all sorts of different costs. We don't want a lot of costs. We want money, right? So if you want money in your bank, you don't have to give it to other people. And this moat actually sucks in a lot of money. So this is not a very good moat. Of course, there are ways that this can be better, maybe with patents or something. But for that, you'll have to understand the company and understand how long this real product differentiation will actually help you as an investor. So the second moat is brand. So we are surrounded by brands in our daily life. We see brands everywhere, and even if we don't like to admit, we all like brands a lot. We all have our preferred brands. We all buy only one kind of burger, we only have only one kind of soft drink. We only buy one kind of shoes, just one brand of jeans. We only watch one brand of films. We ride only one brand of motorcycles. So brands are everywhere. So brands are essentially perceived product differentiation, which means that the product is only perceived to be different rather than actually being different. It can be, but mostly it's not. Mostly it's just, you know, a very small sort of improvement as compared to the competitors. So a brand can sort of evoke feelings of, this different, completely different product or something, even when it's not that different. This is an extremely sustainable moat. As we saw, brands are everywhere, and successful companies do have brands. People are always willing to pay premium for the brand. So even if the product itself is not much better or much different than the others in the market, we still do it. I mean, there are people who buy $20 Apple cloth, you know, and they go to Starbucks only, they buy only Nike. So people are willing to pay premium for the brands. Of course, this takes a lot of advertising. You need constant advertisement. You have to stay in people's minds, right? So advertisements are really a way to stay in people's mind rather than telling them to go and buy. So it's not that they'll see your ad and be like, oh, I just need to have this car. But maybe 4 months down the lane, when they go to actually buy a car and they see a brand that they recognize, they'll probably give it some weight. It'll be a sort of a biased decision. But all brands don't work. That's true as well. So be cautious on which brand you trust. So if it has a long track record like Coca-Cola or Apple or Nike, then you can probably trust it because it has worked for so long. There are very few reasons that will not work in the future as well. The third one is, of course, a very good moat is low cost. I mean, that's probably an easy moat to identify, right? I mean, if you go out to buy, as I said, imagine you being a customer. Why are you buying only from this company and not from its competitors? Because it gives me the same quality at a much lower cost. And I cannot disagree. I would buy that too. So if a company is able to provide a product at lowest cost in the market, it naturally has a moat. You also have to understand how this company is able to do it, because that is the key. That actually is a moat. But so if this company is able to sell something at low cost, why are its competitors not able to sell it at the same cost? So this low cost may be due to economies of scale, which are themselves too difficult to catch up, or through a new technology, better sourcing of raw materials, or by how the business is essentially performed. So there are various ways of cost cutting. So you need to understand how this cost cutting has happened, how your company has been able to drive these costs lower, and understand if this method is sustainable. Because if competitors are also able to follow the same thing, then they will also have low costs in the future. Maybe not now, but 4 years down the lane, they probably will. So try to find a sustainable way of cutting costs where competitors can't actually catch up that easily. And if you find that, you have a great company at hand. The fourth mode is locking in customers, and it is probably the strongest mode out there. Locking in customers means that when a new customer join your company, when they partake in your product or services, they are not able to leave your company easily. It can be due to many reasons, but once they come in, they can't get out. It's probably like Hotel California. So if you are able to make your company a Hotel California, then you have a winner at hand. They can come in, but they can't go out. So how does this happen? How can a company lock in customers? They can do it by either making it expensive for the customers to go out, or making it time consuming, which will essentially be expensive if you think about it in financial terms. So think about it along these lines. Does using products of this company need extensive client training? Say you have this software company that creates softwares, and one of these softwares is used for a particular field, and using this software is not an easy task, and all the people, all the employees of this sector, while before using this software, they'll have to take training. The companies, the client companies will have to train their employees for using this software. Now if a company has already put in that much money and effort into training its employees over the software, then they will probably not leave your software that easily, which means you will get recurring revenues from this software. Is the service integral to the customer's business? Now, if you provide a sort of a product or a service that is very, very critical for the business of your customer, then your customer will probably think twice, thrice, or even 10 times before switching on to a new vendor, because there's this trust and there's proof of concept, and they've used your product for so long, so they will probably hesitate before moving on to a new competitor. Even if the competitor says that they have a better technology or better product, if it's critical to the customer's business, they can't risk it that easily, because what if it doesn't work? Then everything stops, everything breaks down. They don't want that. Is your service an industry standard? Now this is again sort of an extension of the first point. So if this software, for example, that we are talking about is being used by all companies, maybe we're in the chemical sector, then all the refineries are using this software, then there is no reason that some other company in this sector will use some other software. Since this is an industry standard and they have to sort of communicate and transact with the other companies in the sector, they will have to accept this software even when they don't want to, because everyone else accepts this software. So if this service is an industry standard, then you have locked in customers. And the fourth is again an easy one to think about. Does your company sign long-term contracts? If you are supposed to provide this service to a company for 10 years and you have signed a contract, you have definite guaranteed revenues for the next 10 years. So if your company that you're analyzing signs a lot of long-term contracts with its customers, then what it is essentially doing is it is guaranteeing its own revenues for the future. So the cash will keep on coming. It's a guarantee. So think along these lines, and if you find a company that is able to lock in customers, do not let go. Do not let go of this company. And the fifth one is sort of a similar one to the fourth one, is locking in customers and locking out competitors. So what this essentially means is, if your company is able to prevent the competitors from doing the thing that it is doing, then it will keep on remaining successful. So what are the different ways you can lock out competitors? So maybe you have regulations in your favor. So for example, you are the only steel maker that has a license to operate in a particular region of the world, and this region has a lot of iron ore reserves. You will continue making money. Patents. So this is a very important point in the pharma industry. So when a drug is put out in the market, it has a patent, which means that no other competitor is able to use that exact same molecule in its medicines. So if your company has a lot of patents, then it has a very guaranteed recurring revenue stream for the time that these patents last. But of course, always evaluate if your company is dependent on a single patent, because if that expires, it will expire over time. I mean, this, as sure as recurring revenues are with patents, it's also sure that the patent will eventually expire. So make sure that your company is not dependent on a single big patent for all its revenues. The third one is anti-dumping duty. If you have uh, read about the stock market, or if you watch news a little bit, you know that a lot of companies benefit a lot, and sometimes they fall over their head because of these anti-dumping duties. So sometimes there are anti-dumping duties mostly in the chemical sector. So some chemicals get banned. So a particular chemical will not be allowed from China, which means that the local producers of that chemical are now able to address a larger market. They will be able to sell their products at a higher price. So anti-dumping duty is one more example of locking out competitors. and licenses or copyrights, which is a similar one to patents but applicable to different sectors. So make sure that your company doesn't depend on a single regulation or a single patent in their favor, because patents expire and laws change all the time. So there's another important aspect to locking out customers, which is the network effect. So what a network effect essentially is you've probably heard of Amazon. So Amazon is a platform company. It connects sellers and buyers. Correct. So if you create a company at the beginning, okay, and you make sure that a lot of sellers are onboarded. If there's a lot of sellers on a particular platform, the buyers will naturally be attracted to this platform. As soon as the buyers keep on coming, more and more sellers will also keep on coming, because now they have a huge market to sell to. So this is a sort of a virtuous cycle. So more buyers leads to more spending, leads to more sellers, leads to larger inventory, leads to more buyers. So if you find a company that has network effect, it essentially has locked in customers as well as locked out competitors. So think along those lines when you invest, when you're trying to analyze a company. And network effect is again one of the strongest moats out there. So there you have it, folks. We have discussed what economic moats are and what are the different kinds of economic moats. So check your portfolio and maybe try to find out if any of your companies have an economic moat. So thank you for watching. Do like this video if you found it helpful. Share it with people who you think need this information. Subscribe and also comment